What's going on, guys? Welcome back to the channel. In today's video, we're talking about Microsoft. Now, we're going to look at the financial statements of Microsoft and dive deep into the numbers to figure out what this company is doing right and what they are doing wrong. And lastly, what we will do is take a look at the intrinsic value of Microsoft to figure out what we should be paying for this company today. So, loading up Microsoft, the first thing that strikes out to me is not strikes out rather, but what stands out to me is this 52-week range, a pretty wide range, $213 on the low end, $344 on the high end. Now we're currently sitting somewhere in the middle at 246, pretty much closer to the lower end, $246.17 currently at the time of recording this video. So this company's been hit quite a bit, and pretty much since the beginning of 2022, it has been on a downward swing here. And that's what it looks like right now. That's from August currently to where we are right now. And it's been hit quite a bit. So loading this up here in the financial valuations. Now what this software does, folks, it streamlines the cash flow statements, the income statements, and the balance sheets, and provides a score out of 10 to rank the company on certain criteria. So with Microsoft, they're getting a score a 9 out of 10. That's actually really good. That's actually a solid score. The only point where they're getting deducted is in their PE 5-year ratio. So ideally, we want to find companies that are trading at a PE ratio of 22.5 and under. Now that's a pretty fair multiple, as anything higher than that, you are pretty much overpaying, or at least rather paying a premium for a dollar of earnings. So 22.5 is what we're trying to find. Currently, Microsoft's sitting at 35.09. But if you take a look at the company metrics, which is an amazing comparative tool that goes along with the financial valuations, even though our 5-year average is at 35.09, it's currently at 26.37. So currently, it is down from that average. Now, let's go through these numbers here to figure out what they're doing right and what they're doing wrong. So as we established, the 5-year average for the PE ratio isn't the best, but they're doing a lot of things right. The current ratio is 1.84. Now, this is something I like to look at when evaluating a company, because that indicates to me that they have enough assets on hand to cover their liabilities, especially during uncertain economic times, which we're pretty much headed for. We want to make sure the company has some sort of liquidation, and can they liquidate those assets to cover their liabilities in case something goes wrong in the future. And they have that. The return on equity average is sitting at 36.53. That's incredible. We want to find companies that are ideally sitting at 15% of ROE or higher. And if you just do a cross-examination with the company metrics, the trailing 12 months is currently sitting at 42.10, much higher than their 5-year average. So they are pretty much in a better spot they are now compared to where they were on the 5-year average. So that's great. Their EPS is up, so they have a higher EPS growth. Their EPS is growing, so earnings per share is up. That's phenomenal. The debt to equity, which is something I also love to see at an extremely low multiple, 35%, which is great. We want to find companies that have a debt to equity ratio of 50% or lower, so they have that, no problem. They are also buying back shares. Even though it's not a huge amount, they are buying back shares by 0.68%. Not crazy over the last 5 years. So they're not creating any dilution. The net income is up. The free cash flow is up. The revenue growth is up. And the return on invested capital is incredibly high, sitting at 23.97%. This is a company that knows how to flip equity. This is a company that knows how to get a great return on their money. And the trailing 12 months, just bringing this back over to the company metrics here, I'll just pull that up. It's at 31.08. So the way I do analysis, guys, if you haven't noticed yet, I like to go by the numbers. The numbers are extremely important to me because it doesn't lead me into a land of speculation. This is what the company's done, this is what they're potentially going to do, and this is what they've done on average. And to me, that's super important to get a grasp of, okay, what is this company actually capable of? And like when people say, oh, well, the stock price is going to go to this amount or whatever, I don't live in that land of unicorns. Anyways, with that being said, from a financial standpoint, Microsoft is a pretty solid business. They do pay out a dividend, which comes out to be a 1.03%. That's their yield. and that works out to be $18.1 billion of the free cash flow being allocated to the dividend. Now, we want to make sure that dividend is safe. So what I like to do is take a look at the 5-year average free cash flow. 5-year averages, I find, is the solid numeric to try to find out what companies have done over the last 5 years. Is good. 10 years is a little bit too long. 5 years segments, you can see some sort of progression. So with Microsoft, their 5-year free cash flow is at $47.4 billion. They can easily cover that dividend being paid out, as well as use that money towards any kind of other business operations, which is super important. And then if you look at the trailing 12 months for their free cash flow, that's at $63.33 billion. So way higher than their 5-year average. So that's important. The free cash flow is growing. So it's good to see. It's very positive to see that number increasing, as well as making sure that this dividend is safe, because a lot of people sometimes are dividend investors. And something to keep in the back of your mind, folks, is if you're buying a company strictly for the dividend, you want to make sure that they're able to continually pay out that dividend. Some companies aren't able to do that. Now, all that being said, just doing a rough scan here, just to bring it full circle, we have a strong financial valuation, so the balance sheets and everything is strong. Company metrics is good to compare what they're currently doing compared to the 5-year averages. So while their PE ratio is lower than the 5-year average, their EPS is up. The return on equity is higher. The profit margin is also higher. These are major improvements. I love seeing a company that lowers the PE ratio, but everything else that follows is higher. That is important. Last but not least, folks, as I said, we are going to find the intrinsic value of Microsoft. And if you're liking this video so far, folks, hit that like button, hit the subscribe button down below. It means a lot to me, it means a lot to the channel. And we'll load this up here. And I already filled out these lovely boxes, and we'll click calculate in just a second. But this price analysis section allows me to do 3 different assumptions. For me, Microsoft is a $1.8 trillion company. It doesn't make sense year over year for this company to grow by incredible amounts. So with these boxes here, folks, what I like to try to do is I try to stay as conservative as possible and utilizing the historic numbers that this company has provided. So with the profit margin, the 27, 28, 29, I'm just staying within that window of what is shown in the 10-year numbers here, 5 years and 1 year. Everything goes as same thing with their free cash flow margin as well. And their price to free cash flow and PE ratio, I want to find numbers, numerics that are underneath 22.5. So for me, my lucky numbers are 14, 16, and 18. And this is at the end of the 10 years, folks. This is the end of the 10 years. And so whenever those numbers are put into place, you have to think about this is what the company is going to be at the end of that evaluation. And desired return, I put at 13%. And yeah, we're going to click calculate, and we're going to see what this company's stock price comes out to be. It's crunching all these numbers here, and basically the stock price currently at $246.17. It's slightly overvalued. It's a lot overvalued. Right now, the average calculations comes out to be 166.87 based off these numerics here. Now, you may say, Leo, you're a little bit too conservative on your revenue growth numbers, but you have to also keep in mind the current economic status of the economy. That interest rates are rising, so it's going to be harder to borrow money. Consumers are not going to potentially be buying products as much. They're not going to be, cash is not going to be as, let's say, disposable and liquid to the common consumer. So that might hurt revenue growth numbers a little bit, as well as interest rates rising. Tech companies love when interest rates are low, so that's easy to fund R&D. And if those interest rates are higher, that's going to put the brakes on just for a little bit. Now, also the sheer size of this company, as I mentioned, it is a $1.8 trillion company. You have to keep that in mind, folks. The larger the company gets, the slower the company is going to grow. Now, those are my justifications for these revenue growth numbers. But if you want to get your hands on this software and put your own numbers in, follow the links in the description box below. If you haven't done so already, hit that like button and subscribe button. But currently, I love Microsoft. I think it's a phenomenal business. However, the numbers just don't make sense to me at the moment. So $166 is what I'm aiming for. That has to fall quite a bit. Now, do I think it might be just south of 200? South of 200 would be fine. I'm kind of content with if it sits between 6 and 7% revenue growth. but currently at this time of recording this video, it's a little bit too high for my liking. So folks, that is the video. My thoughts on Microsoft is an overvalued company. However, just gotta wait for the price to go down, because other than that, everything is solid about this business. Now, if you enjoyed this video, make sure you hit the like button and subscribe button if you haven't done so already. As well as, if you want to get more info on the software I'm using, follow this video right here. It's pretty much an instructional video of how to use it, as well as follow the links in the description box below to start your 7-day free trial for this amazing tool. There's so many other features that I actually haven't showcased in this video, but you can see it all here in that video there. And I'll see you in the next video. Thank you so much for watching.